To compete globally, we have to think bigger, and we have to think more broadly into what tokenization as a movement, okay, is going to bring to on-chain markets. So to bring RWAs on-chain, to bring locked liquidity into on-chain ecosystems, the digital identity perimeter and its importance in this entire discussion. Is a future regime going to be a markets in crypto assets, or is it going to be a markets in digital assets? And are we just going to start thinking more towards tokenization and really retrofitting the plumbing and the infrastructure? And part of this is being discussed in the market integration supervision package, right? This is a real piece of legislation. It's kind of like Europe's clarity moment, right?
If you're building within the European digital asset market, this is a conversation that will be definitely interesting for you, because it comes at a time where there is one of the most consequential discussion for the future of digital asset in Europe, with the MiCA review consultation happening right now, just at the start of the European summer. In today's conversation, we have one of the most relevant individuals, because he was previously at the European Commission and the European Central Bank, so he has that perspective both inside institutions and policy advocacy for blockchain. It is my pleasure to welcome Erwin Voloder, Director for Research and Strategy at Blockchain for Europe. Welcome, Erwin.
Thanks, Roberto. Pleasure to be here.
And it's really a pleasure to have you, because we can have a conversation not only about what will be the future of MiCA, but also how a reform of MiCA could look like. But before going there, I want to really understand better your background, because your unique experience at the European Commission and the European Central Bank actually give you that viewpoint that not many working in this field right now in advising what a MiCA reform could look like have. So if you can share some of that context that you matured in that experience.
Sure. Maybe even before then. So I've been in this industry since about 14, 15, something like that. So quite some time. I actually started in the private sector. I started in Canada on OTC and in private markets, kind of just dealing with high net worth investors and just doing some consulting. And when I joined the institutions, I was actually focusing first on procurement and competition policy, and then I went into digital transformation of industry. So looking at industrial applications of the token economy. I was one of the first people at the Commission who was looking into the metaverse and Web3 back just around COVID. And then when I went to the ECB, I was focusing more on, interestingly enough, on banknotes actually. So worked on a lot of the payment studies. I was in DG Banknotes, or Director of Banknotes rather, and then transversely working with MIP. So there's some market infrastructure work there as well. And then I went back to the private sector, back into advocacy, public affairs work, consulting. I've worked with, different companies, everything from venture capital and VCs to large issuer protocols. I've advised different member states on regulatory strategy. I've worked with EU accession countries. So it's pretty wide remit. I think that being in the public sector is certainly, I think, in Europe beneficial, because it gives you an idea of how the gears grind behind the scenes and sort of what goes into the legislative process behind the scenes, how that ultimately translates into political objectives and priorities. And I think especially with MiCA during the last policy cycle, because it was part of the broader digital finance package, right? So there was quite a lot of things that were on the legislative train schedule, and it was a Herculean lift, right? Like, it's the first comprehensive regime, and so to have
it was still one of the first globally, so
it still is in terms of its size, scope, and just generally its market impact as well. I think it's one of the most consequential regimes globally. Whether you like it or you don't like it, that's a secondary consequence, but ultimately it's really driven the industry forward, and we can get into a little bit how that's actually materializing on the ground later. But for me, I think at least there's two ways I look at this. Like, I think that there's a whole part of blockchain that is not related to financial services that doesn't get a fair shake. Also globally, I think there's a lot of public goods infrastructure. There's a lot of real economy use cases that are cropping up that are super important, that dovetail in and out of having some sort of financial consequence. But ultimately, the lowest hanging fruit in our industry was on the financial services side. So that's where the most of the gravitational pull comes from. But if you really look at it, beyond MiCA, Europe actually has a lot of real economy companies and startups that are building use cases on blockchain and on DLT, which I think is super special. And that's very, I would say, beneficial for the continent, because it shows that the technology is very transversal. And then, of course, you get into the financial services side where, the regulatory positioning, compliance, risk and governance plays a huge role in how those companies are actually developing products and services.
I'm actually curious about that
Mhm.
transition because you were doing a career that was starting to focus towards a lot towards the public sector. Then you made a transition which was more defining towards blockchain policy discussion and specifically advocacy. Some of the most relevant blockchain association are now at Blockchain for Europe. So how that transition look like? What convinced you to basically focus on this area rather than continuing inside those institutions?
I like to move fast. Just generally, I think that's just a personal preference on how I work. I like to take on a lot of things and like to do a lot of things at once. I think for me, it wasn't even that the work wasn't interesting. I think it's just that the public sector moves a little bit too slow for my liking sometimes, just on a personal level, because the public sector is not facing any KPIs. They don't have any revenue targets or quotas. They get to move at their own pace because ultimately they're on the buy side, right? They're not on the sell side. And when you're on the buy side, you set the pace and you set the rules, which I think for a lot of people who are interested in, having, the job security and all of these things, public sector makes sense. I think for me, I'm very grateful for the time that I spent working in the institutions, and I think that they're super important. But just my own personal way of work, I prefer being in the private sector. I prefer working with companies, getting hands-on with products, and then from that side of the market, also tackling and approaching those regulatory challenges is super exciting, right? I feel really fortunate to be able to speak and to liaise with these companies on a daily basis, because it really is, it's never a dull moment and there's always something new to do. And on the research side, especially, because I'm a macroeconomist by training, it also gives me a wide ambit to then explore also some of my own personal research interests, but things that are super important for the wider development of the space. And then it gives you a mandate to kind of drive those discussions forward, which ultimately anyways trickles back to the public sector because they're one of the end users or the end consumers of the information that we publish. And a lot of the work we do is also for their benefit, not just for the market. So I see them as being kind of mutually beneficial at the end of the day. I just think, again, on like a personal vocational level, it just really depends on kind of what you want out of your life.
Yeah, and I think that you have also identified with the description one of the gap when it comes to the viewpoint when building a digital asset framework, which is the private sector moves faster. That also means that it's the first to witness any constraint or gap within a regulation, especially because it's the one that is building most of the time the infrastructure and also making sure that it follows the regulation, of course, because the regulation brings clarity, but at the same time it see the impact on the overall adoption of this technology, because when we look, for example, at the stablecoin volume, we see that the euro is the second largest currency in the world, and yet it has only 1% of the stablecoin volume globally, which is quite wild. And also it opens a conversation about monetary sovereignty and the dominance of the dollar right now when it comes to the digital asset market. So when it comes to MiCA, what actually worked? Because you mentioned this was a good first, but what is actually lacking when it comes to why the euro stablecoins have struggled to see adoption?
I think, we should step back a second and just understand that dollar-denominated stablecoins had like a 6, 7, 8 year head start just to be on the market, right? And that's a huge moat anyways. And then by measure of the actual volumes, kind of USDT came first and USDC and etc. And I think just being present across so many networks and protocols, being fungible, being there, being convenient, and being liquid really helped them kind of scale, right? So Europe and euro-denominated stablecoins are a little bit later to the party. And so I think just from a distribution perspective, right, that's obviously a gap that needs to be overcome. So that explains also partially why there's a lot more dollar-denominated stablecoins. And because of the way that on-chain activity kind of functions, like those network effects are extremely parabolic. and it creates kind of these entrenched dependencies, ultimately, that the convenience yield on a given form factor of digital money, like a dollar-denominated stablecoin, it kind of like supercharges it, right? So I think that there's ultimately a discussion to be had, and I think that the Euro area is having that discussion around, whether or how and in what way could on-chain Euros support kind of leveling this discrepancy and kind of creating more of these distribution channels and these network effects. I think that dollar-denominated stablecoins and euro-denominated stablecoins also, in some cases, will probably end up targeting similar end users because there's only so many different business cases to go around. And then just generally on a cross-border payments level, there's this figure that often gets cited, which is in like several trillions of dollars of on-chain activity that's being settled in stable coins. But if you really look at how much is used in cross-border payments, it's like 200-300 billion, which is still a rounding error. So a lot of on-chain activity is market making, is liquidity provision, like the vast majority still, right? So which means that stablecoins are finding product market fit, they're finding their USP. But if the end goal is to have cross-border payments, is to have global FX markets, is to have a euro being used by entities and actors and companies in these cross-border settings, I think that we're still a ways away from that, but we're also still a ways away from that for dollar stablecoins as well, because again, the total volume is only around 200-300 billion. Doesn't matter what denomination the currency is in. So a lot of the activity still very much focused on trading, okay? And this is where the lowest hanging fruit was, and so that's sticky, right? Those dependencies get sticky. I think from a sovereignty perspective, and you know that, right? So like the Euro, the ECB and the EU in general are looking at different, like, you have a retail digital euro, you have like Pontus and Appia now on the wholesale rails, but then you also have this, and I've written about this also before, like you have this entire, on-chain economy with agentic commerce and payments and stuff that's kind of cropping up. But if you buy the argument that in, 10, 15 years, a lot of on-chain activity is going to be kind of delegated to or conducted by agents of some sort, shape, or form, they're going to choose or pick the currencies that are the most fungible, that are the most present, that have potentially remunerated benefits, and that the convenience yield on those currencies is super high, right? And I think that if you are not optimizing on-chain activity for those agents to select, your currency won't even be considered. So our issuers in Europe understand this, and so they're building interoperability and they're trying to be present across all these markets. I think from like a business perspective, that mentality, like people are thinking towards that. I think from what often gets conflated is like, will a retail digital euro be the only thing that we need for monetary sovereignty and kind of wholesale rails, or can Euro stablecoins support an international role for the euro? It's my personal view that I think euro-denominated stablecoins should absolutely be part of this discussion. I think that they can definitely support the international role of the euro. But if you look at the way that the architecture is being designed, like a retail digital euro will not be blockchain based. The rails on Pontus and Appia are DLT based. But again, like if you're central bank, you have a perimeter, and your monetary instruments, you want them as close to your perimeter as possible for governance reasons, which makes total sense. But then that leaves like an underserved gap between what's happening at the Pontus and Appia level and what's actually happening in these like institutional retail on-chain markets. And I think that that's where stablecoins could be super crucial to act as this bridge. There's still an ongoing discussion between the market and policymakers on what the exact connectivity layer of that should look like, where the threshold should be, what the prudential regime there should look like, etc. I'm optimistic, at least, that we're going to arrive at some future where stablecoins will have a role. I don't know whether that's going to happen ultimately. I'm optimistic, but there's no guarantee, right? And if you listen to the ECB, they're also very, very bullish on tokenized deposits, on deposit tokens. So, some institutional circles would just prefer to not have stablecoins as part of that architecture whatsoever. Honestly, they're already trying to support the international role of the euro. So I think that that's something that should be more front and center in the discussion. If one day you and I have, we live in Europe, if we have digital euro wallets, retail digital euro wallets, I don't think I'm going to be able to on and off ramp those digital euros onto an exchange or onto a DeFi protocol. I just don't see that happening.
That's also one of the core problems, because right now every European citizen which is active in digital asset market is actually for the most holding USDC stablecoins and not Euro stablecoin because they just are not still there. There is no liquidity. There is not enough supply to build trust from a user perspective. But also there is another story, which is the companies that are actively building stablecoins infrastructure, which in the case of Europe have struggled to comply with MiCA. Probably the best example right now is a Circle that has a Euro-denominated stablecoins. But Tether, for example, they decided to ignore MiCA registration not being part of it. I would say interesting because they are a company with a lot of European inside the company, so they can assume they care about Europe, but at the same time, they decided that MiCA wasn't a fit for them. And this is also where some of the gap with the private sector start to emerge. Do you think there is now a concrete chance to start to go a bit more towards the need of the private sector to actually build this digital asset market in Europe that can compete globally, or the conversation will still lean towards more a focus on the digital euro?
So we have the MiCA consultation right now, it's published a couple of weeks ago, and this is sort of to preempt the MiCA review next year. And if you look at the way that the consultation is structured, a lot of it is actually about stablecoins. It's about asset reference tokens. It's about, the prudential treatment of these things. It's about interest. It's about multi-issuance. It's about equivalence. All of these topics, I'd say like the stablecoin, e-money, ART regime perimeter is like the core. It's like the nucleus of the consultation. So this is clearly something that policymakers understand. I think it's too early to say that there's going to be a MiCA 2. And I'd like to preface that I've seen a lot of this from different people and companies online posting about MiCA 2 is here. There's no MiCA 2. Okay, there's a consultation for pending MiCA review. The Commission has not made a decision or a determination ultimately as to whether it wants a MiCA 2. So are things being looked at and considered and potentially revised? I think that there is scope for that. Otherwise, we wouldn't be responding to it, right? And, our members wouldn't be responding to it. But I think generally that's one part. I think the second part is that to compete globally, we have to think bigger, okay? And we have to think more broadly into what tokenization as a movement, okay, is going to bring to on-chain markets. So to bring RWAs on-chain, to bring locked liquidity into on-chain ecosystems, the digital identity perimeter and its importance in this entire discussion. So is a future regime going to be a markets in crypto assets, or is it going to be a markets in digital assets? And are we just going to start thinking more towards tokenization and really retrofitting the plumbing and the infrastructure? And part of this is being discussed in the market integration supervision package, right? Like, so the DLT pilot regime kind of review, CSDR obligations, these sort of things are kind of moving in tandem. And this is actually like a real piece of legislation. It's kind of like Europe's clarity moment, right? We're discussing these things. It's a massive piece of legislation. From a private sector side, there's obviously desires to have some more flexibility, potentially around reserves, potentially around remuneration, around transparency of the reserve, and these sort of things. From an institutional perspective, a lot of the discussion is still conflating apples and oranges, because just having a digital euro, nobody's saying not to have a digital euro. Have one by all means. But it's not going to solve the structural issues unless it is on-chain, because there are structural issues, there are scalability, and there are demand-side things that need to be solved. Like, for example, European users are holding a lot of US dollar-denominated stablecoins. I mentioned this is primarily because they were liquid, they were first, and so they scaled fastest, and now they're there, and so a lot of people are using them out of convenience, right? Because you need to on and off ramp. But again, if you have European issuers who are able to issue in large volumes and you are in Europe, like, the logical thing for you to do would be to use Euro-denominated stablecoins to settle your on-chain activity in Europe. So I think we're going to get to a future where that is a thing, that is happening. People will do that. It's just insofar as how interoperable does the central banking community want to make its perimeter with that? And will they allow their instruments to be present in those markets, or will we still need a bridge? I personally don't think that the central bank is going to allow wholesale CBDCs to be used as liquidity rebalancing on DeFi protocols. So I still think that there's a large USP for stablecoins there. And just looking at more questions of like, supply chains and industrial policy, there's demand for euro-denominated instruments globally. We have a lot of geopolitical things that are shifting. There is a desire to de-risk from the dollar. And I think that there's a lot of companies and distributors and suppliers in foreign markets who would accept euro-denominated stablecoins as payment for goods and services because they would just generally accept euros. So I think there's a huge USP there as well on the cross-border payment side, which is a huge untapped market and will also, again, to my previous point, help support this international role.
Especially if we start to think more in terms of what is happening globally, as you mentioned, because everyone right now is having a different approach. So we know the approach in Europe with MiCA, but at the same time, there is the United States that is extremely focused on the private sector when it comes to tokenization and stablecoins. They are not looking for CBDC. In Hong Kong, I'm not saying China because there the conversation is a bit more complex, but Hong Kong is a good point of reference of what is happening in China and the APEC in general. There is actually an approach which is leaning towards what you were mentioning, which is both the CBDC, but at the same time on the blockchain rails, and also the adoption of stablecoins. So when it comes to Europe and those learning, probably one of the main concerns is if these technologies, when it comes to the on-chain economy, continue to scale, and we are not talking anymore billions, but we are talking trillions, the digital euro is still happening in 2029. And if by 2029 we are seeing an on-chain economy that goes by the 10, 20, 30 trillion, that could really be a missing opportunity for Europe to compete globally. So how do you see what you mentioned so far compared to the urgency and the roadmap that there is right now in Europe when it comes to actually be competitive in the digitalization of finance?
Look, my personal view is I don't think we're being aggressive enough. I think there's willingness in the private sector to meet the moment and to rise to the occasion and to develop these products and to get them on the market. I think that from an institutional perspective, in some cases, we're still having discussions around like centralized perimeters. On-chain markets will be global. They will be interoperable. If you're not optimizing for interoperability, if you're not optimizing for convenience, if you're not optimizing for fungibility, and one day in the future for agentic rails, currency just won't be selected. And economists are writing about these sort of things and ringing the alarm bells, and not just in Europe, but globally. This is you can witness these changes happen. I think also globally, there's no, as you mentioned, there's no consensus. There's a large heterogeneity around how this is developing. Like in the US, they're kind of front loading all of this onto the private sector, and they're saying, you build the rails, you issue the on-chain dollars and ship. In Hong Kong, they're taking kind of like a middle way approach. Some jurisdictions don't even have a regime. They're just being de facto dollarized. Europe is one of the world's largest markets. It's one of the world's largest consumer areas. It has one of the world's largest GDPs. Is a region. So Europe is never going to be statistically insignificant just by sheer size. There's going to be an opportunity for the private sector. If a digital euro comes by 2029 and it is just used for peer-to-peer payments and it is not a store of value, it's just a unit of account, or it's negatively remunerated, or there's spending limits or holding caps or whatever, I think people will still use it, definitely. In certain cases, I think citizens will not use it. I don't know how successful it will be. I think that ultimately, aside from all of that, stablecoin issuers will continue to develop, they will continue to issue, and they will continue to gain market share. So I think it's going to be hard to ignore Euro stablecoins in 2029 if they continue being aggressive in their adoption strategy. Even if you're the most ardent, hardened, anti-blockchain kind of central banker, I don't think you're going to be able to ignore it.
You made on this regard a parallel that I found very interesting between sovereignty versus autarchy. If you can expand a bit more what you meant there, because I think that was particularly relevant to what you just said.
So sovereignty is having, control over your own rails. Autarchy is mistaking having control over your own rails for building a self-referential fortress.
And you're seeing this happening in Europe right now.
I think that we could end up in that future. I think if we're not careful, and this isn't unique to Europe, I think this could happen to any country or region, or it just depends again on like what is your vision. A lot of the work that we do at the association also is to kind of think about long and hard, where do we want to go? Like, where do we as an industry, where do we as Europe, where do we as a society want to go? And depending on where we want to go, you can then retroactively think about how to get there. But if you don't have a vision, if you don't have an end goal, it's very difficult to do anything that kind of precedes it. So I think there are, certain currents that have a different view of what that future should look like. And there are others that also have a different view to what that view is. And depending on what side of this you fall on, you're going to think one way or the other. We have never, and we won't come out and say Europe doesn't need a retail or wholesale CBDC. That's just, I think this is not something that we would ever advocate for, not something that I would personally ever advocate for. What we're saying is that give the private sector a fair shake to also develop complementary solutions that can help support this in tandem. There was the famous central banking quote that, private money shouldn't crowd out public and public money shouldn't crowd out private. I don't know if there's just front-loading everything on the public sector or front-loading everything on the private sector is necessarily the best strategy. I think there needs to be some sort of balance, right? Like, you still need like a stability and an anchor. And I think that the central bank does provide this in many ways. But I also think that there's use cases for the private sector where we can avoid ending up in this autarchic future. We can build for sovereignty in mind, but still be open, still be interoperable, and ultimately still get things done from a business perspective. Because if we don't, somebody else will. This is the way things work.
And when it comes to the conversation that is happening right now around MiCA, with the blockchain for Europe, and you specifically because you are one of the authors, you made an important contribution in terms of not only of saying, okay, this is where there are the constraints, this is what is working with MiCA. You actually outlined what could be some of the solution in the MiCA Reform Report, which you co-authored with Dr. Ulrich Bindseil, a former ECB Director. So again, someone that has an experience within that institution on the decision making, and yet provide a viewpoint which is towards trying to find a middle ground with the private sector and the adoption of this technology in order to compete globally. So what in that report you focused on and outlined as a possible solution to integrate in MiCA?
Well, several things. Ulrich is brilliant, I have to say. I mean, he has a wealth of experience. He's been, front and center on so many debates over the last several decades. So, it was truly a pleasure and a privilege to be able to write with him and to explore these ideas with him. So I just want to, say that. I think just from a purely kind of like utilitarian perspective to start with, we see a value in remuneration, in remunerating stablecoins, what the exact kind of mix should look like. Because ultimately there's a search for yield that's going on, right? So it's not like you're going to stop the search for yield. Under their kind of regimes in progress, there's also a ban on remuneration, but then this is sort of kicked off to the exchanges who can then, provide rewards. So the issuers kind of pay the exchanges pay the users, and there's this de facto kind of yield generation that's happening. There's also a lot of, compounding and rehypothecation happens in DeFi. So, if I'm not going to get it here, I'm going to go put it into a staking protocol. I'm going to, get an LST. I'm going to wrap it. I'm going to bridge it. I'm going to lend it out. I'm going to compound my yield, etc. So there's like a well-documented phenomenon that a search for yield is a thing, that it's happening, that users want it. Then on the other side, there's the argument that, this can disintermediate the banking sector. You have, stablecoins, if they're broadly understood as narrow banks, they're competing for the deposit base. It's going to erode the deposit base, and therefore this is going to lead to dislocations and mismatch in the economy. And that's also a valid concern. I think that ultimately, and what we proposed was, look, there's a basket of reserves that issuers hold, allow them to remunerate based on a narrow subset of that reserve basket and remunerate at the risk-free rate. So commercial banks are allowed to remunerate above the risk-free rate because they engage in other activities. So they're information monopolists, they engage in cross-selling effects, etc., which gives them the ability to do so, right? And then also they lend out based on this deposit demand cycle. So in order to avoid that, we propose that having that remuneration kind of funneled, and then, we left this open what that mix could be, but then remunerate at a rate that's below what commercial banks remunerate at. I think that this is a good starting point in that discussion. Something else we looked at was also the reserves. So right now under MiCA, there's a 30 or 60% minimum share in bank deposits if you're the depending on whether or not you fall under the significance regime. So if you're significant EMT or a significant ART, so asset reference token issuer. But at least you have to hold 30%.
I actually had a conversation with some company in the private sector and said that this was one of the major constraints they had.
Yeah, so this was one of Tether's main arguments, right? Like they just didn't want to hold 30 to 60% of their reserves in commercial banks, and they pulled out. One of the things, obviously, that we discussed was get rid of the 30 to 60% deposit minimum. And there's broad consensus in the industry that this is something that could be removed or could be amended. And I think the other thing that we looked at was the actual type of reserves then. So like, you have set 1, you have set 2, so you have different categories of reserves. Kind of expand this also into set 2, subject to like a 20% haircut versus set 1. So you kind of maintain that credit flexibility, but you provide a little bit more of this basis for the reserve mix to be a bit balanced, and also to get rid of some of those endogenous or those like built-in dependencies and these kind of like risk loops that could happen in times of stress. We also looked at what central bank facilities that stablecoin issuers could have access to, right? So looking at, lender of last resort and credit facilities are two of the big ones that we discussed there. And I think that there's an opening because there's no real consensus even in the banking community among whether e-money issuers, at least in Europe, should have access, in what form that should take, to central bank accounts. In the States, they're exploring like skinny Fed accounts, basically for some specific purposes under their banking legislation, and something similar like that potentially here in Europe. And then we discussed very briefly, because it's a highly political topic, but also multi-issuance. And I think here there's two schools. There's the one that's the kind of ECB ESRB view, so European Systemic Risk Board and European Central Bank view, that multi-issuance should not be allowed or otherwise should be curtailed and made much more strict, and they're in favor of strict one-for-one equivalence. And then there's the other view that says, other extreme view, okay, which is more like just let things circulate if they're going to circulate. I think neither of those are really sustainable in the long run. I think ultimately, if you look at like what one-for-one equivalence means, I don't think it's ever going to be achieved among any jurisdiction. It's just not possible. I'll give you a very specific example. Like any part of this you want to take a look at, like let's look at the reserves. Like imagine in Europe, I'm allowed to hold covered bonds under MiCA, but in the States, I'm allowed to hold overnight repos. Just the mere fact that here you can hold cover bonds, there you can hold overnight repos, but you can't do it vice versa, would kind of preclude the ability to have one-for-one equivalence on the basis of reserves. So I think what we're really looking at is how can we achieve equivalence of outcome, so the same sort of governance and consumer protection and high standards, without bogging issuers down with having one-for-one equivalence in Europe, the UK, the US, Singapore, Hong Kong.
Is it
Brazil.
multi-issuance also a solution to scale the Euro Stablecoins?
Yeah, if you look at it from the inverse, like if you put strict guardrails on multi-issued stablecoins, you don't really create any goodwill on the other side. So for example, like imagine you're a Euro issuer and you want to multi-issue into a foreign jurisdiction, but you are de facto blocking multi-issuance in Europe. Why would that jurisdiction then accept Euro-denominated stablecoins being multi-issued in their jurisdiction? It doesn't have to be the US. It could be any other country that issues currency, which is all of them. So it's a very delicate discussion because a lot of it also depends on the mechanics of how this is happening. We've been, working also with our membership on trying to find what the optimal solution here is. And I can tell you that there's definitely an ongoing debate, but it's a super important topic for us to be able to provide the competitive floor for Euro stablecoins to be able to scale globally. And that we are on our way to hopefully finding a solution to this. I would suspect that in the course of the next year to 15 months, we may actually have something on paper to show the world that is a union that is kind of working to solve this problem. I think there's going to be a lot of feedback, obviously, during this consultation on the topic of global stablecoins, of multi-issuance, of kind of where the benefits lie. And I think that in the MiCA review next year, this is a topic that the Commission is going to tackle. But I should preface that in this consultation, they've also explicitly worded that, from the Commission's perspective, they think that multi-issuance is permissive. So I think that's also a huge signal to the market that, at least as far as the Commission's concerned, this is the way that I'm reading it, but the words are there, multi-issuance is allowed, yeah? So I think it just depends on how we define multi-issuance, how we define the safeguards for multi-issuance, how we soft land this, and then how do we provide a competitive floor for our euro issuers also to scale globally within that constellation.
So across many of the conversations that I had in the past episode, there is this common agreement that AI agents will be one of the primary user of stablecoins and digital asset in general, because they are striving, as also you mentioned in the report, for capital efficiency. Is the AI argument and the explosion of the agentic commerce something that could actually be utilized to move some of this conversation forward when it comes to speaking with the regulator?
I think more and more, definitely. And I think it's also going to scale in parallel as the use cases come online and as you really see on-chain activity from kind of the agent side scale with it. I think that there's one other point there that's important, and that's that agents need fractionalized money. Agents need to be able to settle micropayments. So if you can fractionalize a given form factor of digital money into like 1,000 units, million units, however many units, and settle, integers of these transactions, I think that that's ultimately what's going to matter. So like, let's say I have 5 digital euro, okay, that's referenced in stablecoin, like a digital euro stablecoin. That could be fractionalized like 500,000 times, and then agents can conduct 500,000 microtransactions with 5 on-chain digital euros. Okay. And this doesn't have to be paying suppliers for goods and services. This could be micropayments for pay-per-use models, for streaming services, for assets that are being under pay-per-use, for tolls. So in smart cities, all of these different things, paying for ride sharing, an e-bike, your Spotify subscription, whatever. So I think that as these things bleed into the general economy more and more, so as more and more agents come online, again, they're going to want capital efficiency, they're going to want microtransactions, and they're going to want them fast. So the throughput's going to have to be super fast. And they're also going to have to be present along this like horizon of protocols. So again, if you're optimizing for these things, I think the currency will be selected. We're also trying to introduce these discussions more and more with policymakers, and you'd be surprised, but a lot of them are actually super aware of this. And I think that's really positive. So they're obviously reading, they're listening, but I think again, like we need to separate reality from hyperbole. Like we don't have a fully on-chain economy yet, okay? These things are coming online, but they're still not the primary actors in our economic system. I don't think we've reached an inflection point where you're gonna see like hyperscalability yet. I think we're like slowly kind of building up to that, the same way as like when a train is pulling out of a station, it goes slowly, and then once it hits its velocity, it's sailing, like it's just cruising along. But we're still in that chugga phase, okay? Like, the gears are still turning, guys still shoveling coal into the engine, the steam is still starting to percolate. But we need to be having these discussions now, because sooner or later this is going to happen. If you look at other jurisdictions, like if you look at MENA region, for example, which I think is one of the true like crypto native regions in the world, really, they're already full on looking at agents. How can they optimize agentic workflows even in the public sector? I think that there's definitely other regions in the world who are taking close interest in this, because ultimately for every economy on the planet, this is going to be an existential question. It just matters how quickly you're going to scale, and not every place is going to scale at the same pace, speed, frequency, etc. I think that for Europe, this is a huge opportunity to be one of the first to really get out there with this and to develop a strong center of gravity and a moat when it comes to agentic on-chain commerce.
Right now in Europe, we have, I'm going to say, mixed signal, because one important signal, especially from commercial banks, is Qivalis, which is a consortium of, I think, 37 banks right now. So that's a very important signal for demand of Euro stablecoins across all these commercial banks that are definitely looking to start to have a competitive Euro stablecoins on the market. On the other side, you have some other news that kind of looks like a setback, like adding a tax on the transaction on crypto, like 0.1%. It is just emerged a few days ago. So the signal is kind of mixed, but it also shows that the conversation is happening and it's quite consequential right now. But as you mentioned, that this is not a MiCA 2, we are not there yet. So what do you think is a realistic scenario? What are the steps to play out in the coming months, years?
I think first we need to understand, again, where do we want to go? Like, do we want a fully retrofitted on-chain economic system where, wholesale rails are fully integrated, issuers have access to pre-funding accounts, LOLR facilities, we have agents conducting on-chain activity, or do we want none of that, or do we want just some of that? And if we want some of that, what percentage of some of that? Like, is it 20%, 50%, 30%? So that's the first thing. So where do you want to go? And once you know where you want to go, then you can start to define, again, retroactively, what the steps to get there. I think from like a purely pragmatic perspective, like looking at it from an ops level, we have a consultation now that needs to be replied to that, actors across Europe will be submitting by the end of August. So it's going to be a busy Euro summer, as you said. And then I think it's incumbent on the Commission to kind of internalize all of that feedback and to see where they would like to take it. We obviously stand ready to have these conversations and discussions. We try to be a resource as best we can. Our members are, always open to have these discussions as well. I think for us, it's really important that we soft land innovation as best as possible. At a personal level, I would like us to move more towards a MiCA rather than just a MiCA in the future. I think that when you look at the zeitgeist of when MiCA was formulated, the word crypto, the nomenclatura around crypto was kind of very prevalent. But I think we've really moved past that. One thing about this industry, and that, is it moves super quick. And it's really starting to harden and mature and accelerate. And so the conversations are becoming much more sophisticated, much more nuanced. There's a lot of former TradFi people that are now moving into crypto. It's not just the degen crowd and developers. It's a mosaic right now, okay, of different people from different backgrounds that bring their own perspectives. So I think that the more this confluence happens, this discussion around digital assets in general is becoming more important. And I think that this is also a sign that we are maturing. And I think we should really focus headfirst into tokenization, to borrow from the SEC chair, the tokenization of everything. But really, like focusing on tokenization. How do we want to have tokenization in Europe? What does it mean? What will it take to get there? How can we bring this activity on chain? How can we unlock the RWA sector? How can we unlock secondary markets? How can we destroy fragmented silos and liquidity? How can we really achieve interoperability? And ultimately, how can Europe as a region serve as a norm entrepreneur in the global standards discussion around all of this, right? So I think that that's something we haven't discussed yet, but it's super important because you can have the best connectivity here, but if you're not connected globally, if there's no interoperability globally, if those standards don't exist, if those levels of common assurance don't exist, it's going to be difficult for anybody. And I think that that's the last piece, the cherry on top. So we've got a chance now to build this from the bottom up. And I think that you will definitely see a lot more activity out of Europe, definitely over the course of the next few years.
Well, thanks a lot for sharing this perspective, and especially for joining for this conversation, because the time is definitely the right one to start this discussion with the European Commission. And for anyone that has been listening, they can find the report, the MiCA Reform Report, in the description of the video. And if you're looking to actually make an impact, if you're looking to bring your feedback, the best is truly to engage with associations like Blockchain for Europe, because they know how to bring this feedback and making sure that the feedback is heard, and hopefully making an impact for an Europe that can compete also globally when it comes to the adoption of stablecoins, tokenization. Thanks a lot, Erwin, for joining us today and sharing this important perspective.
Thank you for having me. And just to say, again, we're reachable on LinkedIn, on X. You can also reach out to me personally. Just drop me an email on LinkedIn. I'm always happy to have a discussion around these things. Our door is always open to companies who want to get involved, learn more about what we do, and become part of the conversation.